one thing I would probably also highlight is that an observation from my learning as well, that if you are able to kind of mitigate risks on an overall basis, then the possibility for you to generate a very good alpha is huge.
Introduce myself. My name is Vikas Agrawal, and I'm the founder and CEO of AIF and PMS Experts India. It's a platform for investing in alternate investments and portfolio management services. With me, I have Mr. Vaibhav Sanghavi. Vaibhav doesn't need any sort of introduction because you would have seen him on various business channels like CNBC. He's also been invited in various events many times because he understands economy well, and he's known for generating risk-adjusted returns very well. That's what his forte is all about. So he brings about almost 2.5 decades of experience on the table, having worked with a couple of large organizations like HDFC, DSP Merrill Lynch, Ambit Capital, Avendus, which was his previous avatar. Recently, he has taken over as Chief Executive Officer at ASK Hedge Solutions. At ASK has been into ASK, in fact, is one of the largest portfolio management services companies in India. They've added up another vertical under the able guidance of Vaibhav now, and Vaibhav will be managing a couple of hedge funds out there.
Yep.
So, without any further ado, I would hand it over to Vaibhav, and then over to you, Vaibhav. Thank you so much for accepting our request.
Thank you very much, Vikas. I think it's great to be here. It's a pleasure, to come to AIF and PMS conclave and kind of present my, views and opinion about, overall long short strategy. Is it that I am getting a disturbance, or probably Vikas, are you able to hear me?
Yeah, very well.
Okay.
You can share your screen also for the presentation.
I will share my screen as well. Sure. Just a second. I mean, present. Yeah. Is this? Yeah, perfect. So what I'll do, Vikas, on this presentation is one that will go through the whole concept of long short funds, of course. At the same time, try to kind of portray that how long short funds are not only complementary, but it is beyond only buy and hold strategies, which you may have probably in your portfolios as well. So, while everybody has that kind of fantastic knowledge about, you have to stay long, stay invested, and get that kind of fantastic kind of, outcome of it. What I'll do is basically carry on these three slides, all these slides, try to build up, the basic parameters of investing. What is it that, quite often we err as an investor, and where is it that we can probably use long short funds to kind of mitigate those kind of inherent biases which we may probably have as well. So in that respect, probably, what I'll do is basically first, ask a simple question to, every participant, that whenever you're thinking about investments, and these are all very, very basic slides at this point in time, the center point of any discussion around any investments is always the aspect of returns. We always excessively focus on returns, while it is one of the very critical parameters to kind of assess your investments, but it is not the only critical parameter or only important parameter. While return is important, many things along with returns are equally more important. Why I do say that is basically, it also comes to the fact that when we talk about return, I think we should ideally focus on achievement of our financial goals rather than being obsessed on returns. And one might wonder that, why are we talking both as separate? Purely because at the end of it, returns contribute to your achievement of your financial goals. The only difference here is basically where I would say that when we talk about achievement of your financial goals, then we are a lot objective in terms of our decision making. And when we are objective in terms of our decision making, then the excess of greed or emotions in pursuing the returns is something we kind of keep it aside as well. So in that respect, what I would definitely think about is one should definitely focus on achievement of financial goals, and in that pursuit, try to kind of have various different parameters which you may need to assess your investments, and which again comes back to the same question that while everybody is thinking about returns, how is it that I can have a complementary suite of buckets of products to kind of see how I diversify my return profile and bring that uncorrelated returns into my overall portfolio. Now, having said that, I mean, I will also try to, kind of highlight is that while we talk about returns, uh, one should also be, extremely careful of understanding the various profile of returns within their respective asset classes. What do I mean by that is that equity has a very different return profile, and within that asset classes also there are various strategies which can kind of change the return profile as well. So, for example, equities by itself, and if you talk about a very well diversified equity portfolio, there is a particular configuration of your return expectations. At the same time, when we talk about a sector specific fund or very theme based fund, or we talk about a fund which has lesser of net exposure from an equity fund, in each of those respects, I think the return profile kind of vary a lot. And when we understand this, let's also kind of marry this along with something which is the another critical component, and I would term it as one of the most critical component is something called risk. Now, talking about risk is, I would say a very boring subject and probably a non-fashionable to talk at this point in time, because everything, if you see from a market perspective, is doing extremely well. Everybody is making tons of money, but that is where one has to look about in terms of what are the factors or what are the risk factors which may probably arise. At the same time, I'll just give you an analogy is that why it's very unfashionable and unpopular at this point in time is when you go to a simple sweets shop, while you are very excited about having all those kind of sweets or candy stored, if somebody comes and reminds you that, excess of sweets is not good for health and diabetes is something which you need to take care of, at that point in time, everybody ignores that. But it is extremely important that for you to enjoy those kind of sweets for a very long period of time, it is very critical to control your health on an overall perspective. Now, while I say that it is kind of often ignored subject, and how kind of risk plays an important part in our decision making, one thing I would probably also highlight is that an observation from my learning as well, that if you are able to kind of mitigate risks on an overall basis, then the possibility for you to generate a very good alpha is huge. What do I mean by that is I'll come to those kind of data slides in the subsequent part of my presentation. But point here is basically that if you take care of those risks, you can make much good value add to your portfolio. At the same time, when we ignore risks, then there is a huge hazard as well to get kind of stopped out at the lowest point of your investments. So, not saying that you should be obsessed by risk, but risk is something you should always take into mind while assessing your investments, in addition to kind of returns, what we always talk about. Which brings to again one more point is while we talk about risk, while we talk about return, what is the essential purpose of talking about both these two subjects? One, that if you see from a very long period of time, a simple nifty return over a 15, 18, 20 years would deliver you about anywhere between 13 to 15% on a CAGR basis. It's a fantastic number. However, the problem is that sustenance of those investments over a longer period of time is kind of extremely critical for you to enjoy those foods. When I talked about risk and when I talked about that, when you don't control your risk, you get stopped out at the lowest point, is when you are not able to fructify those financial goals, in terms of getting those kind of returns for yourself. So it is critical to be in the market for an extended period of time to kind of capture the growth opportunity on an overall basis, right? Thus, most one of the, as I said, most critical piece is to be, I would, sustainable for a very long period of time. Now, this is a very simple slide of Nifty, right? We have plotted right up from 2005 to 2023, a simple Nifty kind of, if 100 rupees kind of invested in 2005, you would have held up back to 2023. You would have made some 100 would have gone to about close to about 800 rupees, which is again a very fantastic number in terms of the overall returns. But the problem again is that while we talk about all these long-term kind of investments, one important fact which comes along with that is the behavioral patterns of your investments. Why I took that example is basically the sustenance of long-term investments is critical. What typically happens is basically that you will have all these gurus, you'll all these experts kind of coming on to the television channels to buy and hold for a very long period of time. But usually data has shown us that that has not been the case. Why has that not been the case? And I will show you that data in the next slide, which is on this slide, where effectively what we are saying is, if you carefully notice, especially two periods of investments, one is around 2008 and the other one is around 2020, again near the COVID period. At 2008 crash, when we saw global financial crisis, what we saw at that point in time is huge amount of dent in your, in terms of your market sentiment and your depreciation on the indices. But at the same time, post after that, over a longer period of time, you saw that market slightly recovering and then kind of giving you a great opportunity to invest. Now, when we talk about 2008 end or 2009 beginning, that would have been one of the best periods in terms of our investments. And similarly, 2020, when COVID hit, and I do remember post crash of March 2020, when the indices fell about 25% in one single month, that would have been a fantastic time again to invest. But what does the data show in terms of the net mutual fund inflows? Post 2008, when the valuations were extremely attractive, appealing, and probably the best time to kind of invest at that point in time, subsequent to 4 years after that, you didn't virtually see any inflows coming back to the mutual fund side. At the same time, from a 2020 perspective, after the whole crash happened, and when we had to see that the investments are kind of need to be made at that point in time, you saw in the next 6 months actually mutual funds outflow kind of happening. Why is that so? When everybody is expecting that markets are good from a longer period of time, and when it's cheapest, why are we not able to invest? It is the simple fact that we have to accept something that emotions and psychology affect our decision-making process while kind of investing. Now, in that respect, I mean, if we see, again, from a 6 months perspective, subsequent to that crash, you saw a very sharp increase in terms of the markets as well. So in effect, I think it is important to mitigate those kind of risk aspects to better our drawdown profile and keep giving us that consistent returns over a longer period of time, which brings to the point of golden point, from our perspective, that what is it all about? It is all about something called risk-adjusted returns. What it does basically is to bring to the fact that you marry both returns and risk on a very balanced kind of way, in which what you try to do is basically, while you diversify your portfolios across styles, streams, what it happens is basically it to a great extent kind of softens the blow when the market is not doing well, from your portfolio perspective. It also kind of helps to kind of see to that how we can better our drawdown profile, give you confidence of investing for a very long period of time as well, right? So when we talk about again risk adjusted returns, is to an extent I would highlight you a very simple traditional risk return dynamics. Again, this chart is not kind of plotted to the scale, but what we can see probably on this is basically we've just plotted a normal kind of investment horizon starting from about liquid funds or money market instruments, running up to a diversified equity kind of portfolio, meaning just a simple thing that low risk, low return, higher risk, higher return. Is there a possibility where we can deviate from this normal risk, risk return curve? Of course, there is a possibility, which comes to the main point of our kind of discussion, which is beyond our long only kind of investments or a buy and hold kind of investment philosophy. That brings to the core point, which is the long short funds, which we do term as a methodology or a tool which is available for anyone to kind of generate returns on a risk adjusted return basis. Now, when we talk about long short funds, while Wikipedia kind of gives you a very simple definition that long short equity is an investment strategy generally associated with kind of hedge funds. It also involves buying of equities that are expected to increase in value and selling short equities that are expected to decrease in value. Now, when we talk about long short funds, one has to understand that long short funds or methodology is just a tool to kind of generate products or generate strategies or generate returns, right from being extremely conservative to kind of extremely aggressive as well. It can be a simultaneous long short fund, or it can be long or a short fund, meaning it can take directions on either side depending upon the market condition. Now, each of those kind of strategy would have their own different risk and return profile. But the point being is that long short funds has the ability to kind of smoothen out the risk and return curve to a great extent, giving you overall confidence of staying invested for a very long period of time. Let me walk through a very simple illustration. One, if you see on this slide, I have given scenarios divided into 4 quadrants. Top left is a long only investments in a bull phase. Top right is long only investments in a bear phase. If you see the below half quadrant is on the bottom left is the long short in the case of a bull market, and on the right below is the long short in the case of the bear market. What I've done is on a simplistic basis, I've given you a return profile of how would each of those strategies kind of perform in different market conditions. One, if you are a long only fund, in a very bull market, in a good bull market, of course, the returns would be fantastic. But at the same time, a simple long only strategy in a bear market would give you a very different kind of return profile, wherein you would lose good amount of money as well. Again, coming to the point, same that in 2008 and 2020, when it kind of happened, people just got out seeing those kind of negative drawdowns, thereby completely missing out the subsequent rally which happened to the markets. Now take that same scenario of bull and a bear market into a long short strategy. When I am doing long and short simultaneously, and what I am aiming for is my selection in terms of how do I do my long and short, in each of the market conditions, whether it is down 10% or plus 10%, I am continuously making money. Now, one might also wonder that at some point in time, the long only strategy I'm making 11%, and in some point I'm losing 9%. But a long short strategy is keeping, is kind of delivering you continuously, say about 2% in this simple example. Then how does it justify in terms of your portfolio? Now, two things again to this is basically one, people often ignore or kind of underestimate that if you keep avoiding the negative drawdown periods into the markets, the cumulative effect of that consistent returns would to a great extent outperform your markets over a longer period of time. A simple example is in our experience of my last 17 years of long short money, with just very small miniature net exposure which we carry from a long and a short perspective, we've been able to outperform gross return perspective markets most years out of that 17 years, which is, to be very honest, unbelievable, purely because we've seen consistent returns coming about from a long only perspective, but long short actually giving you that kind of consistency as well as a bit better returns from a gross return perspective. Right. So I just wanted to make that point is basically that long only, a simple example, comes along with huge amount of market risk. Of course, that I'm not saying that is not important for the portfolio. It is important for the portfolio. You keep those kind of investments, but at the same time, diversify into strategies which are long short, giving you risk adjusted return and kind of improving your overall drawdown profile and your risk profile as well. Next is basically what I would think is basically from here is I would also want to highlight few of the important risk matrices which you probably want to take care of while choosing a long short strategy. Important ones are starting from volatility and standard deviation, meaning that the returns, the underlying returns which I am generating beneath the strategy, at what standard deviation or volatility is it coming about with? At the same time, what is the drawdown profile of that strategy? How much maximum negative I have been in that kind of strategy? Thirdly, it is something called a Sharpe ratio, which is again extremely important to track. And one of the most important factors again is basically to try and do a scenario analysis. And why I would spend a minute on the scenario analysis here as well is because, often because our history is such, say, for example, in the last 3 years, the market has been, fabulous in that instance, right? Giving you minimum volatility, you at every given point in time making returns. So it's a very shorter history to actually track those numbers from a volatility or the standard deviation perspective. What is important is that the underlying strategy at some point in time, if it goes up by 15% of market or down by 20% of the market, what is the impact of that onto your strategy is very important to notice, which will kind of give you an overall picture that how you kind of go about investing or choosing, those kind of strategy, whether it kind of suits to your risk appetite as well. Lastly, you also do think about the beta and probably the correlation to your overall portfolio. At the same time, correlation to the underlying benchmarks as well. So those are the critical parameters one might obviously want to probably look while choosing a long short strategy. What I would do is basically, before I kind of try and wrap it up quickly, what I would say is here that when we talk about long short strategies, there are various streams of long short strategies. It can be right from a single strategy to kind of a multi-strategy long short fund. You can have a fundamental long short strategy as well as quantitative long short strategies as well. In quantitative, you can segregate between high frequency, mid frequency, and low frequency. And lastly, a combination of quants and fundamental, we do call it that quantamental as well. Now, this is something which I've just put for as a basic understanding, but there are many iterations, many complications, and many different strategies which can come along with a long short umbrella. It is extremely, as I said, important to look at those kind of risk factors which I kind of mentioned earlier, to try and find out what is best for your portfolio return perspective. Before I end, I just want to also make a point that everyone talks about returns, and for us, primary is the risk management. While we do think that once the risk management is there, return is just merely a byproduct. And why do we say that? Is because if you do your risk management well, it gives you a chance to be invested into the market for a very long period of time. And once you are invested in the market for a very long period of time, you can look at how each of those asset classes have delivered returns, and you would be able to fructify those kind of returns with your investment or within your financial goals, which we are looking about as well. So, a risk-adjusted return concept, which again Vikas did mention it right at the beginning, is something one should definitely look to add to your kind of portfolio. Because I'll probably end here, and thank you very much for running with the presentation.
Thank you, Vaibhav. It was a great, insightful presentation. What you rightly mentioned, managing risk is the most important aspect, and therefore returns will be an outcome. So byproduct. So you've been doing it. In fact, you were the early one to start the whole hedge funds. In India, in your previous avatar at Avendus, and before that at Ambit and DSP to some extent, along with Andrew. So great insights, and you've been able to manage risk so well. Remember listening to you during the COVID time. You were the only one who talked about the risk metrics those days and reminded all the investors that how important it is strategically to have allocation towards long short category, which is emerging very well in India. So thank you so much, and on behalf of entire AIF and PMS Experts India team, I wish you best wishes for your future endeavor in ASK.
Thank you very much, Vikas. It has been a pleasure.
Thank you. So Manvi.